Hi, good afternoon, guys. I mean, only about a third of you are here. So I kind of thought about it. I'll briefly talk a little bit more about chapter 8, but I actually want to kind of have some thoughts on current state of the market. What sort of messages market is giving, given the political environment, economic environment. In terms of biases, you guys can read the technical analysis stuff. Uh, There are two main categories I want to put in. One of them are heuristic biases. Heuristics are basically simplified rules that people follow. Okay, they're not necessarily optimal, but they do not need that much thought. For example, some people never buy in a stock if a certain percentage of analysts do not give a buy or strong buy signal. Some people sell stocks when analysts give sell signals and stuff like that. That does not necessarily an optimal strategy, but it reduces for investors to think about stuff. Some people, when they're allocating, even if they're not picking individual stocks, especially in retirement funds, they do simple stuff. Let's say I have 10 choices available in my 401k plan. They divide the money into equally or almost equally to 10, and they just leave it at that. Some people don't even worry about it. Some certain plans have things like target retirement date funds. Somebody came up with some formula. If you're going to retire in 30 years, there should be this many stocks, or this percentage of stocks, this percentage of bonds, yada, yada, yada. Uh, People don't want to think. So, oh, somebody already thought about this for me. So they just put their money in there. The trouble is, those funds are uh, basically the mutual fund managers or 401k managers' way of getting your money for fees. So all those target day funds are comprised of individual funds. On individual funds, you're already paying management fees. Then these guys are basically charging you fees on fees as well. So, in fact, let's say you believe in that target fund stuff. These guys in their prospectuses tell you uh, 2045 target day fund, target year fund, 70% this fund, 20% this one. You already know what they are. All you have to do is replicate it yourself, you're done. But people do not think about these stuff. They don't want to make decisions. So they just let those go. And that sort of stuff adds up. Now, hoarding is an interesting bias. This is not limited to individual investors. It is probably going back to our caveman days. We like the security of numbers. When you're alone in the jungle, a lion can come and get you, right? But if you're hunting in groups, you can be a lot more successful. A lot of these things, think of it this way: whether or not you believe in natural selection and evolution or not, back in those days, the people who hunted alone were a lot less likely to survive. The people who hunted in groups, they were more likely to survive. That means those genes have been passed. So we have those, even though we don't need those genes anymore, it's still there. It's like we have an appendix, right? I mean, does anybody know what an appendix does? I have no idea. I don't even know if it has a function. I mean, it does create issues every once in a while. You have to have a surgery, but other than that, nobody knows. So there are these vestigial organs. Similarly, these are vestigial genes. They're there, but they are so much ingrained in our essentially genetic memory. Then, especially if we don't want to make decisions, we feel safer in numbers. So, why was the iPhone so popular when it first came out? So many people bought it. If you didn't have an iPhone, you felt isolated. Again, we can discuss technically whether it was justified or not. To me, it was, but my 10-year-old kid didn't need an iPhone. But I had to buy him an iPhone. You know why? They were going to private school. Other than the teachers, we were the poorest family in the private school. Don't get me wrong, I'm not poor. But relatively speaking, when a 10-year-old kid has all their friends have iPhones and they don't, they feel isolated. So you pay the cost, you heard. And, it creates issues. Later in life, it doesn't matter that much. And similarly with investing, people heard. Why did so many people buy NVIDIA last year? I mean, to me, it was justified. They bought NVIDIA because they saw their friends make a lot of money from NVIDIA. So they heard it. Or if somebody's selling something that is hurting. Hurting is not even limited to amateur investors. It's very common among analysts, for example. As you know, many stocks have analysts recommending them, right? Let me see. Let's go find, for example, FinanceYahoo.com. Let's look at my favorite stock in the whole wide world. Let's do the analysis page. For example, earnings estimates for the current year, which is 2026, because NVIDIA's fiscal years ends in January. There are 51 analysts that are making estimates for NVIDIA earnings. And look at the range. Relatively speaking, it's a narrow range. It ranges from $4.13 to $5.33. Remember, NVIDIA is doing a very high-tech stuff. And given all the uncertainties in the world, political and otherwise, a lot of things can happen. The very fact that that range is so narrow actually tells you that a lot of analysts do not want to be too much away from the consensus. The so-called consensus is the average. The average estimate is $4.50. Okay. And a low estimate, in fact, look at the difference. Low estimate is only what? Yeah, it's about 10% below that, but there is more room on the high estimate. Now, if you estimate NVIDIA's earnings too low and NVIDIA blows it out of proportion, as an equity analyst, that's going to reduce your reputation because you couldn't see the big potential. If you estimate it a little bit too high, more than likely your clients are not going to be that angry with you. So people heard. In fact, you can even see uh, the, for example, EPS trends. Let's look at this. 90 days ago, people thought it was going to be 433. Current estimate is 4.5. So it kind of keeps themselves there. Uh, and look at this. These are the revisions. Last 30 days, 27 out of 50 revised up, and more around here, so on and so forth. When you follow these revisions closer to the earnings announcement dates, suddenly everything starts getting back. The difference between the low estimates and high estimates tend to close down because they don't want to be wrong. And these are the so-called top analysts. They tend to be a little bit more liberal in future growth estimates, partly because cost of getting those wrong is not that high for the analysts. If you say over the next 5 years, NVIDIA is going to grow 100%, they only grow 50, nobody's going to remember it in 5 years. But if next quarter you say NVIDIA is going to make $10, they only make five, everybody's going to remember that. You know, a lot of equity analysts are actually get their bonuses based on accuracy of the forecast. Uh, so if you're not too wrong, you don't get fired. Some people are adventurous. They say, I truly believe this. They're going to make $10, so they predict $10.